Hi, this is Bennett Tchaikovsky, and we're back with part 2 of our adjusting entry video, going over a base problem going through with adjusting journal entries. There's the first video on this, which I would recommend you watching prior to watching this one. So just a brief recap, we were given a unadjusted trial balance. We were given various different items of additional information on which we had to go through and create adjusting journal entries. We then put all of those, we made journal entries out of those. We then also put those adjusting journal entries into the T accounts. What we then did is we made an adjusted trial balance, and that's kind of where we left off. And so right over here, what we're going to do is we're going to start next by doing an income statement. When we do an income statement, this is what we call a single-step income statement as opposed to a multi-step income statement. It does not refer to the multiverse. Rather, what it refers to is to going through and showing all revenues minus all expenses is giving us total income. And just as a brief reminder, this material is copyright 2008 to 2019 by Bennett Tchaikovsky. All rights are reserved. Any distribution or redistribution is strictly prohibited. The videos and the opinions or statements in this video are those of my own and not of my employers, including the South Orange County Community College District, Irvine Valley College, or Chapman University. Any distribution or redistribution is strictly prohibited. So we're going to go ahead and do an income statement. So the way we're going to do our income statement is we're going to say RHI income statement. And we're going to say here for the period ending 12/31/19. Now just remember, when I go here and look at the question, it's for the year ended because the income statement is showing us a period of time. So we're going to start over here with our revenues. We're going to have services revenue. And we're going to have consulting services revenue. And what's also kind of important, like right here, is that just if you're, as kind of a reminder, do not combine revenues and expenses on my exams. If you're in private, you'll be doing that all the time, but not for my test. Also here, notice here, when I'm pulling these balances over, even though these are credits, I'm not saying debit, credit on any of the financial statements. If you do that on a test, it's not going to be a good thing. If you look over here at Macy's, do you see any debit or credit over here on the balance sheet? Absolutely not. It doesn't happen on the balance sheet or on the income statement. Doesn't happen. We're just listing out the values. Okay. So again, that debit credit part is just to help us as accountants tell to make sure that we're on the right track. So my total revenues is going to be 170,000 less my expenses. Okay, now really important are dividends and expense, and the answer is no. Dividends are a distribution back to the shareholders, and we'll get to why that's important in just a moment, but it is not included over here. So what I'm going to do is I'm going to list out all of my expenses. So when I list out all of these expenses here, okay, so my insurance expense was 16,000, utilities 35, interest, and then we get down to office supplies expense. So my total expenses here, and again, I'm just pulling these off of the adjusted trial balance. So my total expenses here are going to be 103,000. So my net income is going to be my revenues minus my expenses, or $67,000. So that is my income statement. The next statement that I'm going to be asked to prepare is my statement of retained earnings. Why do I prepare the statement of retained earnings next? Because this statement of retained earnings is the bridge between the income statement and the balance sheet. Very, very important to be preparing this next. So the way I do this is I start out with my beginning retained earnings. What are retained earnings? It's those earnings that I've generated as a company, but that I am not giving back to the shareholders. I'm retaining them. So the ending amount of whatever I have not given back to my shareholders is my balance of ending retained earnings. So my beginning retained earnings as a business right over here is going to be 0, okay? We're gonna add our net income, and our net income for the period, this is why we have to do the income statement first, is $67,000. So let's put a little green highlight there for all you fans of that 420 holiday. Okay, less dividends. And then right over here, my dividends are going to be $30,000. It's going to give me ending retained earnings. Okay, my ending retained earnings are going to be right here at $37,000. Okay, so now I have enough information to go through and then prepare my balance sheet. However, before I do that, I do things a little bit differently. Some of you may have used something called income summary. What I need to do though is I need to make a post-closing trial balance. And so when I make a post-closing trial balance, what exactly is that going to be? Well, a post-closing trial balance is essentially something that is going to be taking all these revenues and expenses and making them 0, and as well as dividends. Any amounts that are appearing on the income statement and the dividends have to be closed out to 0 in order to get to my retained earnings that is over here. When I'm doing a post-closing trial balance, okay, over here my cash, my office supplies, my prepaid insurance, my equipment, my accumulated depreciation on the equipment, which is a contra asset account. All these liabilities here and these equity accounts are not changing at all because they're going to carry over to the next period. However, all these temporary accounts need to be closed out to 0. So the way that I do this is going to be a little bit different than what you may have seen before. So let me pause really quickly and show you what we're going to do. Right over here, you have all of the temporary accounts listed out. Consulting services revenue, consulting services expense, and all these different items. What we're going to end up doing over here is we're going to bring forth the balances from this trial balance over here. So what we're going to do is we know that our beginning retained earnings balance here was 0. My depreciation expense over here is going to be, let's go ahead and make this together right now. My depreciation expense is going to be $5,000. My consulting services revenue, $30,000. Supplies expense, $1,500. My consulting services expense is $20,000. My interest expense is $1,500. My insurance expense is $16,000. My utilities expense was $35,000. My rent expense was $24,000. And then my dividends were $30,000. Yeah. And then over here, my services revenue were $140,000. What I'm doing at this point is that all of these temporary accounts have to be made 0. How do I make it 0? Well, what I'm going to do is that, so say here for supplies expense, what do I need to do to make the account 0? Well, I need to credit supplies expense over here, and we'll make it ourselves a little bit easier for us as we're going through and doing this. So I need to make this 0 over here. So, and as we've said here in accounting, for every debit, I need a credit. And for every credit, I need a debit. So if I'm crediting supplies expense, that means I'm going to be debiting retained earnings. So right over here, I'm going to go ahead and debit that retained earnings. for that $1,500. Okay, so I made an error over here in terms of consulting services revenue. This should have had a $30,000 credit balance. And let's go over here. So in order to make consulting services revenue 0, so sorry about that slip up. If I look right over here, consulting services revenue has a $30,000 credit balance on the adjusted trial balance. So right over here, to make this account 0, what am I going to have to go through and do? What I'm going to have to do is I'm going to have to debit consulting services expense for $30,000. This will basically then make this account 0. And for every debit, I need a credit. So what I'm going to do over here is I'm going to credit retained earnings for $30,000. Okay. So for depreciation expense, to make this account 0, I need a credit over here for $5,000. So I'm going to go ahead and make this over here for $5,000. To make consulting services expense 0, I'm going to need a credit for $20,000. For every credit, I need a debit. So I'm going to go ahead and make this debit over here. Okay. So again, I'm closing out these temporary accounts, interest expense. I need a credit over here of basically of $1,500. So for every credit, I need a debit. And I've done this in several other videos before, so if I'm going too fast for you, just go ahead and take a look at some of those videos. Okay, this is 0. This here has also been zeroed out. My interest expense has also been zeroed out. Okay. So my insurance expense over here, to make this 0, I need a credit of $16,000. For utilities expense, and then for rent expense, I also need credits over here for $35,000 and $24,000. Again, these will make these balances over here 0 balances. So again, right over here, $16,000. I've got over here a sorry, just one moment. All right, we're not the highest quality production, but then again, you're not paying a lot to watch this video. Okay, so then over here, I have to debit retained earnings for the utilities expense, and then I have to go ahead and debit rent expense over here. For dividends, to make this 0, I need a credit of $30,000. So I'm going to go ahead and debit retained earnings for this $30,000. And then lastly, over here for services revenue, and again, I made an error. This should have been a $140,000 credit. Do I make mistakes all the time? Right over here, $140,000 credit. So when I went over here and pulled those balances over, I should have had over here a credit to services revenue. So for here to make this account 0, I'm going to need a debit of $140,000. And then for every debit, I need a credit. So I'm going to basically credit my retained earnings over here. Now, if I've done this correctly, and hopefully I have, my ending retained earnings should be a $37,000 credit. So let's see if we got it to work. So I got over here $170,000 in credits. And then over here, I had total debits of $133,000. So my difference here is $37,000. So this $37,000 over here is equal to what I had over here in terms of this $37,000. Now, what you're going to notice here is I'm going to go ahead now when I'm doing my post-closing trial balance. Remember, the assets, liability, and equity accounts don't get touched during the post-closing trial balance phase. Rather, we're going to be putting in our new amount here for retained earnings. But if we notice over here, all these other temporary accounts, because of what we just did in this whole process, right? All these accounts have now been zeroed out. So as we go through and look at this here, dividends are 0. My services revenue, my consulting services revenues are all 0. All these expenses have been closed out. And what I'm left with over here are my totals. So this, again, is how we go through and we close out various different accounts. So that's how we make a post-closing trial balance. And now what we are ready to do is to create our balance sheet. So I'm just going to pause real quick and we'll start getting that set up. Okay, we're back. Now what we are ready to do is to do our classified balance sheet. Classified balance sheet does not mean top secret. What it means is that what we are doing here is we are separating so the investor knows what we have here are current versus non-current assets. So what you'll see here is we're showing total current assets, which by definition are going to be used within the year. And then we're going to have had all of our non-current, which used to be called long-term, but they don't do that anymore. Rather, they just dump it out. And we're going to get our total assets. Similarly, over here with current liabilities, you're going to have total current liabilities. Now, this is a very important number because it tells the investor when those liabilities will in fact be due. So, and then we get our non-current liabilities, and then we get to shareholders' equity. They total shareholders' equity, and then we see that here. So I'm going to do something a little bit differently just because for totaling's sake and so that we can kind of get it, is that RHI balance sheet as of 12/31/19. So here I'm going to have my assets, and we're going to start over here with current assets. And my current assets are going to be cash, meaning anything that I'm going to be using within the next year, office supplies. Now, prepaid insurance is unique because why? Well, prepaid insurance, we have, I think, something on the line of about 16 months left on that policy, which is beyond a year. So the technically correct way would be to bifurcate it between current and non-current. However, because the amount is not very material, what I'm going to go ahead and do is just include it as a current asset. Also over here, I'm going to have my accounts receivable. This is going to give me my total current assets. And so when I list these out over here, generally the assets should be shown in their order of liquidity. So I might want to actually go through and make those that accounts receivable higher. However, this is just kind of more of like a review. And I've already made a mistake in this right over here. Let's see here. I've got cash, prepaid insurance. Oh no. Okay, I see what I did. Sorry, guys. Sorry, everybody. Let's go ahead and do that. Okay, so let's make sure we got this right. So I got cash of 280, office supplies of 1,500, prepaid insurance of 32,000, and accounts receivable of 30. So my total current assets are going to be 343,500. My non-current assets, I'm going to have equipment. And my equipment here was 130,000, less my accumulated depreciation on equipment. And this is going to be a negative 5,000. It's going to give me equipment net over here of $125,000. So my total non-current assets is going to be $125,000. My total assets are going to be over here of $468,500. Remember, our balance sheet is showing us the AELOE, okay? Meaning our assets are equal to our total liabilities plus our owner's equity. Okay, so that's our assets. My liabilities, I'm going to have current liabilities. Now my current liabilities are going to depend upon when the liability was actually due. So as I come over here, what I kind of need to go through and do is read the additional information. And if I look at my liabilities right over here, I see that I have accounts payable, which I know is going to be current. My unearned revenue is something I'm going to have to earn out in the next year. But this loan payable and the related interest payable, I need to take a further look at. So let's take a look at that loan payable. So loan payable, It basically says that principal and interest are due on September 30th, 2021. Well, if we look at the balance sheet right over here is as of December 31st, 2019. If the loan is not due until December 30th of 2021, September 30th, 2021, that's beyond 1 year, meaning that it's not going to be payable it's not going to be payable by December 31st, 2020. So therefore, my current liabilities are going to be my accounts payable and my unearned revenue. So it's a very important distinction. So my total current liabilities are going to be $130,000, okay? My non-current liabilities are going to be my loans or my loan payable, and then I'm also going to have over here my interest payable. Sorry, so right over here, my loan payable is 100. My interest payable is going to be 1,500. So my total non-current liabilities is going to be right here of 101,500. So my total liabilities are going to be 231,500. Okay. Lastly, I'm going to have my total liabilities are equal to my total assets are equal to my total liabilities plus my owner's equity. So I'm going to have my owner's equity, which is going to be my common stock at par, additional paid-in capital common stock, and then my retained earnings. So over here, my common stock at par, it's $1. Additional paid-in capital stock, common stock is $199,999, and then my retained earnings were $37,000. So my total owner's equity is going to be $237,000. So my total liabilities plus owner's equity is going to be $468,500. Now I have when you look at a balance sheet, I've kind of gone through over here, and I know a lot of people have taken instructors. They're probably freaking out because of the formatting that I'm using, which is essentially none. But I'm not as concerned with the formatting as that you are understanding how to properly classify everything. So again, for me, if you're taking my class, I'm not as into oh, you got to show, X, Y, and Z, or, look at this. I mean, everybody does things differently. So I'm just saying right here, in terms of the double underline and those kind of things, at least in my class, I'm not as concerned with you doing that as you are preparing a balance sheet, which shows me that you know how to go through and properly classify and record information. So that is this question. And again, just to kind of recap the first video, we did the adjusting journal entries, but we really kind of more focused on the T accounts first, created an adjusted trial balance. And then this second video, we made an income statement, closed out our temporary accounts to retain earnings. We prepared a post-closing trial balance, and then we prepared a classified balance sheet as of December 31st. So thank you for joining me here today. Hope to see you on the next video. Don't forget to like and subscribe, and have a great one. Have a good one. Bye-bye.